This video combines budgetary accounting, encumbrances, and budgetary comparison reporting because the CPA exam tests the full life cycle of budgeted transactions from planning to actual spending. All right, treat this explainer as your absolute deep dive into the exact mechanics you're going to need to understand to pass the bar exam. We are getting straight to the point today, no fluff, just the highly testable, technical structure you need to know.
To absolutely master this topic for the exam, you've got to internalize one foundational rule. Listen closely. A government budget is legally binding and used for control, not just planning. An encumbrance is a commitment, not actual spending. And an expenditure is actual spending. Think about it. In corporate accounting, a budget is just a nice guideline, right? But in governmental accounting, exceeding the budget is literally breaking the law. So everything we cover today is going to follow this exact unbreakable life cycle. Budget to commitment to actual to comparison. If you can hold that sequence in your head, all the complex journal entries we're about to see will logically fall right into place.
Okay, let's start at the very beginning with the first stage. The second a budget is adopted, governments record specific budgetary accounts right into their governmental funds. The big three are estimated revenues, appropriations, which by the way simply means authorized expenditures, and the resulting budgetary fund balance. Now, you absolutely need to know that these accounts are strictly temporary. They're used purely for internal control throughout the fiscal year, just to monitor spending limits. And because they're just internal control mechanisms, they are explicitly not reported in the government-wide financial statements, no exceptions. They exist solely at the fund level to keep the government legally compliant. If a multiple-choice question ever asks you where appropriations are reported on the government-wide statement of net position, the answer is always nowhere.
Let's move on to the next big concept, encumbrances. In the governmental accounting world, encumbrances record commitments related to unperformed contracts for goods or services. They are triggered the very exact moment a purchase order or contract is issued. By recording an encumbrance, the government instantly reduces its available spending authority. It effectively sets aside a chunk of those appropriations to prevent overspending. It's like putting a protective fence around those specific funds so nobody else in the government can accidentally spend them. But, and this is a massive but for the exam, you must remember this rule. An encumbrance is never an expenditure, and absolutely no liability is created when an encumbrance is recorded. Remember, an encumbrance does not equal an expenditure. So let's zoom out and look at how these pieces fit into the full end-to-end life cycle of a transaction. This sequence is absolute gold for the exam. Step 1, the budget is adopted. Step 2, a purchase order is issued, which automatically means an encumbrance is recorded. Step 3, the goods are actually received, which strictly dictates that the encumbrance must be reversed at the full original amount. And finally, Step 4, the actual expenditure is recorded at the actual cost. Let me reiterate our core principle right here while we look at this sequence, because it's that important. A government budget is legally binding and used for control, not just planning. An encumbrance is a commitment, not actual spending. And an expenditure is actual spending.
To navigate these business analysis and reporting, or BAR, exam questions successfully, I highly recommend you adopt this 4-step mental framework. Honestly, jot this down on your scratch pad the minute you sit for the test. Step 1. Ask yourself, what stage are we in? Are we at the budget, the commitment, or the actual spending phase? Step 2. Is there a liability yet? Step 3. Are we dealing with temporary budgetary accounts or actual financial accounts? And Step 4. What's the impact? Are we merely impacting spending authority, or are we hitting the actual fund balance? Applying this framework systematically is exactly how you're going to stop yourself from falling into the examiner's classification traps.
Okay, let's dive into this framework with a really comprehensive example. We're going to track the city of Clearwater. The city adopts its general fund budget for the upcoming year. They officially project estimated revenues of $500,000, and they legally authorize appropriations of $480,000. Now applying Step 1 of our framework. What stage are we in? Well, we're strictly in the budget adoption stage. We are simply setting up the legal parameters for the entire fiscal year. Here is the exact journal entry to record that original budget. We are going to debit estimated revenues for $500,000. Then we credit appropriations for $480,000. To balance the entry out, we credit budgetary fund balance for $20,000, which represents the anticipated surplus. Just a quick side note, if appropriations had exceeded estimated revenues, we would have debited this account to show an anticipated deficit. But notice what is happening here based on our framework. There is no liability yet, none. These are purely temporary budgetary control accounts. This entry establishes the legal spending authority for the year, but it does absolutely nothing to affect actual revenues or actual expenditures. Fast forward a few months into the year, and the city of Clearwater realizes it needs some new equipment. So the city officially issues a purchase order for this equipment in the amount of $80,000. Boom! We have now moved from the budget stage directly into the commitment stage. The goods haven't arrived yet, and no invoice has been received. The city has simply committed a portion of its authorized appropriations, but legally, they don't owe a single dime yet.
To accurately reflect this commitment, we've got to record an encumbrance. The journal entry here is a debit to encumbrances for $80,000 and a credit to budgetary fund balance-reserve for encumbrances for that same $80,000. Applying our framework once again, the stage is commitment. The liability? Strictly zero because we owe nothing until those goods actually show up. These are purely budgetary control accounts. And what's the impact? Well, this entry merely reduces our available spending authority to ensure the city doesn't accidentally go and spend that $80,000 on something else.
All right, time passes and the delivery truck finally pulls up. The equipment is delivered, the city receives the goods, and the actual approved invoice comes in at $76,000, so slightly less than they originally estimated. We have now officially entered the actual spending phase, and this event triggers two very distinct, highly critical steps in our accounting life cycle that the CPA exam is going to test heavily.
Now, what's really interesting about this slide is the incredibly strict rule we have to follow. First things first, we must reverse the original encumbrance. The journal entry is a debit to budgetary fund balance-reserve for encumbrances for $80,000 and a credit to encumbrances for $80,000. The absolute critical exam rule here, and I cannot stress this enough, the examiners test this relentlessly, is that the encumbrance must always be reversed at the full original amount, in this case $80,000. You never reverse it at the final invoice amount. You take off the books exactly what you put on the books to clear that commitment completely.
Immediately following that full reversal, we execute the final step of the life cycle, recording the actual expenditure. We debit expenditures for $76,000 and recredit vouchers payable for $76,000. Let's run this back through our framework. The stage is actual spending. Does a liability exist? Absolutely. Yes, it does, represented right here by vouchers payable. These are actual financial accounts now, not budgetary ones. And the impact is a definitive, real reduction to the actual fund balance. Now, you might be wondering about that $4,000 difference between the estimated commitment of $80,000 and the actual cost of $76,000. It doesn't just disappear. It simply flows right back into available spending authority, meaning the city can now use that $4,000 for other legally approved purposes.
To really drive this home before we move on, let's state our core principle once more. A government budget is legally binding and used for control, not just planning. An encumbrance is a commitment, not actual spending. An expenditure is actual spending. Grasping the distinction between an estimated commitment and an actual cost is totally foundational to passing this section of the BR exam. Encumbrances track the estimates, expenditures reflect the hard economic reality.
Let's look at this direct comparison. You really need to clearly categorize these concepts in your head. Look at budgetary accounts. Their purpose is planning and control. They create zero liability. They are completely temporary, and they are totally omitted from government-wide statements. Now look at encumbrances. Their sole purpose is tracking commitments. They also create no liability, and they absolutely do not represent actual spending. Finally, look at expenditures. Their purpose is to record actual spending. They do create a legally recognized liability, and they definitively reduce the fund balance. Keeping these categories strictly separated in your mind, especially when it comes to that liability column, is exactly how you navigate those tricky multiple-choice questions. Examiners are going to constantly try to trick you into recognizing a liability during the encumbrance phase. Don't fall for it.
Ultimately, all of this complex data we've been talking about has to be reported to the public. State and local governments must provide what's called a budgetary comparison schedule, and this brilliantly illustrates how the whole life cycle comes together. The format requires very specific columns. You must show the original budget, which is the legally adopted appropriations at the start of the year. You must show the final budget, which includes any legally authorized mid-year revisions. Then you show actual amounts, and crucially here, actual means expenditures. Finally, a variance column is often presented, showing the exact difference between that final budget and the actual expenditures.
Now here is a massive trap for candidates when it comes to year-end reporting. If a city has open purchase orders sitting there at year-end, meaning goods were ordered but just haven't been received yet,
These open encumbrances absolutely do not count as actual expenditures on that budgetary comparison schedule. They are not actual outflows of resources. They really only matter for interpreting the remaining budget authority. What happens is they are typically reclassified as committed or assigned fund balance for the following year, just to show the public that those funds are still obligated.
So the crucial point is understanding exactly how the exam is going to evaluate you. The bar exam tests the chronological sequence of these entries and your precise classification skills far more than it tests complex math. Most mistakes come from candidates simply confusing an encumbrance, which is just a mere commitment, with an actual expenditure. If you adhere strictly to the life cycle we discussed, if you recognize exactly when a liability actually forms, and you never forget that full reversal rule for encumbrances, you are going to effortlessly avoid these common pitfalls. Let the sequence be your guide.
Let's wrap this up by reinforcing everything we've just covered. Remember our core principle one last time. A government budget is legally binding and used for control. An encumbrance is a commitment, not actual spending, and an expenditure is actual spending. Master this entire life cycle from budget to commitment to actual to comparison, and I promise you will be fully prepared for this topic on the bar exam. But it leaves us with one final fascinating question to ponder. If governmental funds require this incredibly strict, legally binding control over every single penny, what happens when a government operates like a business, say running a public water utility? Do these rigid budgetary rules still apply, or does the accounting playbook completely change?